It is no secret that data centers are going up throughout the country and the world, and those data centers need to be powered. And so the companies that can provide that power have seen their stocks go up a lot lately. Well, one of the biggest providers of natural gas turbines that are driving this build out is GE Vernova. And the company reported earnings before the market opened today. And by and large, it was a very positive quarter. But there were two things that stood out as potential yellow flags, and the stock was actually down about 7% before the market opened. So why, given great results, a beat and a raise on revenue, and this massive wave of the AI infrastructure build out, would we see this happen? Let's spend the next couple of minutes trying to figure this out. My name is Brian Stoffel, and at the time of this recording, I do own shares of GE Vernova. Want to give a shout out to Fiscal AI for sponsoring today's video. More from them in just a minute. So this was GE Vernova's second quarter of 2026. The market cap, depending on what happens throughout the day, is somewhere in the ballpark of $280 billion. All right, let's look at the top line first. Management does not offer quarterly guidance, but revenue came in at $11.1 billion. That's up 22%, and it beat analyst estimates. Now, the bottom line, things get a little trickier. Earnings per share grew 33%, which is great, but they actually did miss analyst estimates. We'll get to one of the reasons why that was the case in just a minute. Let's take a look at margins. And by and large, this was a very good picture. Gross margins expanding, operating margins expanding meaningfully, net margins expanding. Free cash flow balloon. I'm going to talk about more of that in just a second. Net income was up nicely, and the balance sheet is incredibly healthy. Now let's talk about that free cash flow for a second, because believe it or not, these enormous natural gas turbines, I mean, they're absolutely enormous. To get one of those, you need to be in a waiting line to get them. And in order to keep your spot in line, you need to prepay and pre-deposit some of the money for that order ahead of time. That is creating massive free cash flows for GE Vernova. Now, there's two ways to view this. One way is this is very positive because GE Vernova can expand capacity, bring more gigawatts online over the next couple of years, and they can do that, and the customers are funding it. They don't need to go into debt doing it. They can use those deposits to do that. Long term for the business, that's great. But we do need to remember that that is not a steady state free cash flow. Once supply and demand even out, this isn't going to be something that we're going to see a whole bunch of, because as it is, these natural gas turbines are largely going to be booked through 2031 by the end of the year. That's right. They're going to be booked. All the natural gas turbines that they can deliver are going to be booked through 2031, so that if you're getting in line starting next year, you're not going to receive that natural gas turbine until 2032. All right, let's look at the income statement to see what's going on here. So overall revenue was up 22%. Now remember, GE Vernova is capacity constrained. There's two different types of revenue. We need to talk about these two different types of revenue. One is for the equipment, the natural gas turbines, the electrification. They do have a wind unit as well. Believe it or not, those things are growing really fast, even though they're capacity constrained. So that grew 32%, but they also have services revenue. And we'll get to why this services revenue is more important than you might think. That means that these natural gas turbines are going to sit there for 20, 30 years, and over that time period, only GE can service them. Now, that total revenue only grew 10%, but a big reason for that is that it's the backlog and the orders that are going out right now that are growing so fast. It's only after they're installed and have been in those factories for a certain period of time that they're going to then need the servicing. So it's not going to show up right away. What's more important is what's going on with margins. Now, overall, the cost of the revenue is only up 20%. When revenue grows 22% and the cost of that only grows 20%, that's really good news. But let's look at, so gross profit, that's why it was up 28%. But what we really need to do is look at each one of these segments. Now, here's the thing. I said the equipment is what's growing really fast, and that's great. But the margins on this aren't amazing. They're improving, which is definitely important. And management thinks that they will continue to improve. So one of those natural gas turbines you might sell for $100. Obviously, it's way more than that. You only keep about 13 cents in profit. So even though this is growing really fast, it's less margin based. Now, if we look at the services, those margins are more than double the margins you get on the equipment. So even though it's not growing as fast, it has a very long tail. And look at the margins here. They expanded meaningfully. So over the short term, it's the equipment sales that get investors excited. But over the long term, it's the services that should really be exciting. What else is exciting is that operating expenses were only up 16%. Again, grow your revenue 22%, operating expenses only 16%. Look at what you get. You get operating income growing 73%. There's real operating leverage here. Now, net income, remember the EPS miss, that was a little bit of a bummer. It only grew 30%, but a big reason for that was because of a big jump up in income taxes that the company had to pay. It's also worth noting that the number of shares outstanding was down 2.2%, which is also great news. What else happened during the quarter? Well, for that, we're going to head to Fiscal AI. Now, look, this is a tool I use every day. If you're an individual investor, I strongly suggest considering it. If you want a 15% off annual membership, second link in the show notes below will get you just that. Okay, so GE Vernova has 3 different units, and I pulled them up here on Fiscal AI. This blue one is the biggest one. That's the power division. That's where those natural gas turbines are. It does also have some nuclear plays, but they're much smaller. The orange is the electrification revenue. This is basically what GE Vernova offers to keep electrical grids up and running. And then it has this wind unit. And the wind unit, as you'll see, is really dragging things down. So let's look at how these segments did. So overall, the power unit saw a very strong quarter with revenue up 14%. Remember, it is capacity constrained. It is not like it can meet every order that's there. So while 14% might not sound exciting, they are trying to up their production abilities within reason to meet demand as quickly as they can. 14% growth in power, very solid. If we look at electrification, this one is a little bit easier to ramp because it doesn't involve enormous machines like natural gas turbines. And we can see that the electrification revenue was up very nicely, up 68% year over year. That is an enormously important thing. And if you look, this orange segment is becoming bigger and bigger. Electrification is going to be one of the things to really keep your eye on, at least over the short to medium term. But again, this wind unit is where the real trouble is. It used to be a much bigger part of the company's revenue. It has been shrinking over time, which is actually a good thing. The main reason for this is that what they offer is being commoditized away by cheaper alternatives that come from China. We saw that revenue for that division fall 10%. So this is the main drag on things. Now, that's not the only thing that I want to look at over here in Fiscal. The next thing that I'm going to pull up here are remaining performance obligations. Now, remaining performance obligations is like equipment that the company has contracted to be able to deliver, but they haven't actually delivered it yet. And what's important here is look at the growth. So their remaining performance obligations for equipment, largely in power, but in all the segments, it was at 76 billion just 3 months ago, and now it's at 88 billion. And the growth rate continues to accelerate. Now, we'll talk about in a second whether or not we think that this might be reaching a peak, but we'll get back to that in just a second. The important thing is that we see that this growth rate continues to accelerate. That is very, very important. So that's the equipment side. Remember, short to medium term, really important. The service side is the other part. Now, the service remaining performance obligations, the level is much, much higher, right? It is $88 billion, but it's always been much higher. It's actually almost on par now with the equipment. The reason that historically it's been much, much higher is because this stretches out over decades. Now, while its growth might be less exciting, this is higher margin, almost annuity-like revenue that will be coming in for years and years and years into the future. And this growth rate of 12-ish% is really important. Largely, it just means that they're placing 12% more machines that are going to need servicing year over year. And it takes time for that to compound, but over time, that can really, really drive results for the company. The last thing that I want to look at is just overall orders. So orders in the power division are in the blue. Orders in the wind division are in the light blue, and orders for electrification are down here in the red. And so what we can see here is that total power orders just really is just going through the roof, up 135% year over year. If we look at orders for the wind unit, you see how it is really not looking good, down 40%. And if you look at all this, it's mostly been down. They had like one good quarter or two good quarters, but off of a very small base, and it's not looking good there. That's just, as I said, it's going to be a drag. Electrification, a lot to love here. I mean, look at the number of quarters. This really is easier to scale than the power division, and it is doing a lot of the heavy lifting right now. Now let's take a minute to just talk for a second about the growth rate of orders for the power division. I'll pull that one up. So if we look at the power division, what we've got here, 135% growth. What I want to point out is that on the conference call, two different analysts asked management whether or not 2026 would be the peak for natural gas turbine orders. And management largely deflected that, which leads me to believe it could be the peak, even though they're contracted all the way out through 2031. The point is that that could start to turn over. Now, that probably wouldn't be great news for GE Vernova, but it probably also wouldn't be great news for a lot of the AI infrastructure stack. It's possible that companies are just waiting to see where demand is and that it could pick up again in 2027, but it is worth noting. Now, the downside protection comes from those service contracts that the company has that are much wider margin, but valuation plays a huge role in that, and we'll get to valuation in just a minute. So when we talk about guidance, management they upped guidance to a midpoint of $46 billion for the year. That's 21% growth. Analysts were hoping for 19% growth, so that's good. They also meaningfully revised upwards their guidance for free cash flow. It was for $7 billion, now it's $12 billion, way ahead of analysts' expectations. But again, we need to remember, a lot of that are those peak orders being prepaid, which artificially inflate free cash flow. A great way to pay for expanded production capabilities, but not something that you should bake into your valuation assumptions. So what am I going to watch as a shareholder moving forward? Well, first, I want to keep an eye on that order growth. I want to know, is 2026 the peak year for natural gas turbine orders? Number two, are the losses from the wind division? Because look, they really are a drag, and I would love to see them become less and less important, or at least stabilize. Number three are margins. Those gross and operating margins are really important. And number four, free cash flow. I'm going to keep my eye on it. I'm going to expect that it will come down as the inflow of orders above where they have been in the past kind of stabilizes, but I still want that to be meaningful. I do think that the moat is stable, if not widening around the company, and the thesis is very much on track. But valuation is everything, especially if there is some level of cyclicality here. And the services contracts do kind of even out that cyclicality, but it's still worth keeping an eye on. Now, before I get to valuation, which is really important, I want to point out that if you enjoy content like this, you would be a great potential member for Stock Investing Mentor. Now, I've tracked my results over the years, beating both the NASDAQ Composite and the S&P 500, and you'll learn how to do that in Stock Investing Mentor, which comes in three parts. The first part is 1 hour of live weekly training on Thursdays at noon Eastern that are recorded. You get full access to my real-time portfolio with explanations of every move I make. You get access to a private online investing community. And for free, we are throwing in Stock Simplifier, our updated version, which goes live today. Now, there's a whole bunch of different things that you get with Stock Simplifier, which is a $300 to $400 value that we throw in for free with Stock Investing Mentor. But the one that I want to focus on right now to give you a taste of what it can do is the valuation tab. So as you can see, I pulled up GE Vernova. I've gone to the valuation tab. If we look at GE Vernova just on a PE basis over the last couple of years, because remember, this company was just spun out of GE, we see that it's actually trading for cheaper than it has for quite some time. Its trailing PE of 28 is pretty reasonable for a company that is seeing its backlog and its orders grow by so much. We could even look at price to free cash flow, currently trading at about 22 times free cash flow, although we do need to keep in mind that that free cash flow is artificially high right now. But what I'd really like to do is do a reverse discounted cash flow analysis on this. Now, this is my favorite tool out of all the tools that we've got. I'm going to show you how I would use it. Remember, you get this for free with Stock Investing Mentor. So the first thing I want to do is I want to say, what kind of terminal growth rate could GE Vernova have? And I want to give them, we'll call it a 3% terminal growth rate. What kind of discount rate? I use 10% discount rate as the baseline for everything because we're assuming that this is a market matching result. We want to know what type of expectations are baked into GE Vernova's stock price. Okay, here's where it gets tricky. We need to optimize the free cash flow margins. Now today, those free cash flow margins are north of 30%. There is no way that I believe that they will be 30% in the future, again, because they're getting all of these deposits right now that are really bumping up their free cash flow margin. I think a more reasonable free cash flow margin would be somewhere around, let's call it 19%, 18 or 19%. I'll give them 19%. So I just chopped a huge chunk of free cash flow off, being a little bit conservative here. So if we do that, then revenue needs to grow about 15% per year. That's what this shows right here over the next 10 years to justify today's stock price. Well, what do we think? Is 14, 15%, is that reasonable? Well, let's go see what analysts are expecting. So we can go back to Fiscal right here. We can close out the windows that we have, and we can just pull up, let's see where revenue has been. Let's see where revenue is going. I'm going to put this on the annual view. I'm going to pull this all the way out. And what I see is that we know that management is now calling for 21% revenue growth. So I'm going to change this and say I think they'll get 21% revenue growth. And this says 14% in the 2 years thereafter. Now, it's worth pointing out that if we look at history, the analysts have consistently been underestimating for about 2 years this company's revenue potential. So I'm going to say that I actually think that this company could do 22% growth, followed by, let's call it 16% growth and 16% growth. I would say that over the 3-year average, I think this company could get about, let's call it 17.5% growth. Now, here's why that matters. I'm going to do a split growth here, and I'm going to say that over the next 3 years, I believe that GE Vernova could grow revenue by about 18% per year. Here's why that matters, okay? This is why I love this tool so much. What are we saying now? We are saying that if GE Vernova can have a 19% free cash flow margin, and if it can grow revenue by about 18% per year over the next 3 years, well then, from year 4 to year 10, it needs to grow its revenue by about 12.5%. But it's also buying back a lot of its own stock. So I would say that I could lower that in my mind to around, let's say, 11%. Does that seem reasonable that GE Vernova could grow their revenue by about 11% per year from years 4 through 10? Well, that's tough to say. And here's why it's tough to say. As you can see, this company has a very short history. I think that that's somewhat reasonable. It, to me, does not make it a screaming buy. It, to me, is not unreasonably expensive either. So I think GE Vernova is largely fairly valued. The most important thing to see is what happens with those orders once we get into 2027. Do we hit peak orders? What are the service margins looking like? And does that annuity allow the company to repurchase stocks potentially at an even cheaper price in the future? That's what's going on with GE Vernova. I think the main reason that the stock is down are the questions about those peak orders and that wind unit really dragging things down. Let me know what you thought of GE Vernova's earnings in the comment section below, and don't forget to hit subscribe. Till next time, Brian out.